Welcome to the Explainer. We're about to dive into a really thorny part of the tax world, something called the contingency fee tax. It's a situation where you could be forced to pay the IRS for money that you never even touched. Sounds crazy, right? Let's break down how this actually happens. Okay, let's just jump right in with a scenario. Imagine this. You win a lawsuit, a $100,000 settlement. Awesome, right? Your lawyer, on a 40% contingency fee, gets their $40,000 cut. So you pocket $60,000. Now here's the $1 million, or I guess $100,000 question. What's your taxable income? The $60K that's actually in your pocket, or the full $100K? You'd think it's the 60, but let's just say the IRS sees things a little differently. And that's where we get to the heart of the matter. This is what we're calling the contingency fee tax. It's this bizarre phenomenon where you're taxed on the gross amount of your settlement. Yep, that includes the big chunk that went straight to your lawyer. It's like being taxed on phantom income, money you earned on paper, but that you never, ever actually possessed. So how on earth is this legal? All right, to really understand why this happens, we've got to dig into the foundation of U.S. tax law. Now, the IRS didn't just pull this out of thin air. Their entire argument is built on two really powerful, really old legal principles that have been around for almost 100 years. So, the first key concept is gross income, and you'll find it in Internal Revenue Code Section 61. The definition is, honestly, massive. It basically says income is from whatever source derived. The Supreme Court nailed it down even further in a case called Glenshaw Glass, saying it's any undeniable accessions to wealth. The takeaway, if it makes you wealthier, even for a split second on paper, the IRS wants a piece of it. The second big piece of the puzzle is something called the Anticipatory Assignment of Income doctrine. That's a mouthful, but the idea is simple. It's a rule to stop you from dodging taxes by just giving your income away before you get it. You can't tell your boss, hey, just pay my salary to my brother so I can stay in a lower tax bracket. Nope. The rule is crystal clear. The income is taxed to the person who earns it, period. And this whole idea was beautifully captured way back in 1930 in a case called Lucas v. Earl. Justice Oliver Wendell Holmes came up with this brilliant metaphor. He said you can't avoid tax by giving away the fruit, that's the income, if you're the one who owns the tree that grew it. It's such a simple, elegant idea, but it's the bedrock for everything we're talking about today. So let's see how the IRS applies this fruit of the tree thing to a lawsuit. It's actually pretty clever. They say the lawsuit itself, your legal claim, that's the tree. And who owns it? You, the plaintiff. The settlement money, well, that's the fruit that grows from your tree. So that contingency fee agreement with your lawyer, that's just you assigning some of your fruit as payment. You're not giving them a piece of the tree. And since you own the tree when the fruit was grown, you're on the hook for the tax on all of it. Now, you might think this sounds straightforward, but for a long, long time, it wasn't. For decades, the courts all across the country were totally split on this. It was a mess. You could literally have a completely different tax outcome for the very same settlement, just depending on which state you filed your lawsuit in. Yeah, the whole country was basically divided into two camps. On one side, you had a few courts, like the Fifth and Sixth Circuits, that believed in something called the Lien theory. Their take was that the contingency fee basically makes a lawyer a co-owner of the lawsuit. So they argued the plaintiff never even had a right to that fee money in the first place. But most other courts went with the assignment theory, our fruit and tree metaphor, saying the fee is just an expense the plaintiff pays out of their own income. What this meant in practice was pure chaos. It was a totally uneven playing field. You could have two people, identical cases, identical settlements, but one person in Texas pays way less tax than someone in New York, all because of this legal split. It was a broken system, and it was screaming for the Supreme Court to step in and fix it. And step in they did. In 2005, the Supreme Court decided to finally settle the debate. They took two different cases, one called Banks and another called Banatees, and combined them into one massive landmark case that would create a single rule for the entire nation. The big case was Commissioner v. Banks, and when the decision came down, it was a thunderclap. It was unanimous. Every single justice agreed. This was it, the moment that would set one single clear rule for how contingency fees are taxed no matter where you are in the U.S. And the court's logic was just surgical. They went point by point. First, they said a fee agreement is an expense, not a partnership. Second, they confirmed the lawsuit is the plaintiff's asset. It's their tree. That means paying the lawyer is a textbook case of assigning your income. And the final nail in the coffin, they declared that these big federal tax ideas, like the fruit of the tree, are more powerful than any state-level laws about attorney liens. So just like that, the debate was over. The Supreme Court made it the law of the land. That question we asked at the very beginning, do you pay tax on the 60 grand you kept or the full 100 grand? The court's answer was loud and clear. You pay tax on the full $100,000. The entire gross amount goes on your tax return as income. But wait, the story doesn't stop there. Just when the courts made things simple, Congress decided to jump in. And what they did was create a whole new set of rules and exceptions, which, you guessed it, led to a brand new and maybe even more complicated system of winners and losers. Check out this timeline. It really tells a story. Look at the dates. The first law, the American Jobs Creation Act, or AJCA, actually came out in 2004, a year before the Supreme Court's Banks decision. They saw which way the wind was blowing. But the real bombshell? The thing that created the mess we're in today didn't drop until 2017 with the Tax Cuts and Jobs Act, the TCJA, and its impact was huge. So let's talk about that first law, the AJCJ. It was actually a pretty elegant solution for some people. It created something called an above-the-line deduction, specifically IRC Section 62A-20. Now, this is the holy grail of deductions. It means you subtract the attorney's fees right from your gross income before you calculate your adjusted gross income, or AGI. In effect, it completely cancels out the bank's ruling for those who qualify, letting them pay tax only on the money they actually took home. But, and this is a huge but, this amazing tax break wasn't for everybody, not even close. Congress targeted it very narrowly. The deduction was only for cases involving what the tax code under Section 62E calls unlawful discrimination. Think employment lawsuits, civil rights cases, some whistleblower claims. If your lawsuit was about something else, too bad. You were left out in the cold. Now, before 2017, if you were one of those people left out, you still had an option. It wasn't great, but it was something. You could take a miscellaneous itemized deduction. It was a below-the-line deduction, which is less powerful, but hey, it helped. Then, the Tax Cuts and Jobs Act came along. With one little section, IRC 67G, it just poof. It suspended all miscellaneous itemized deductions. Gone. At least through 2025. And that right there is what created the modern-day contingency fee tax trap. So now you have this whole group of plaintiffs, people with cases for things like defamation, bad faith insurance, business disputes, who are stuck. They have to follow the Supreme Court's rule and report the entire settlement as income. But thanks to that 2017 tax law, they have absolutely no way to deduct the giant fee they paid their lawyer. It's the worst of both worlds. This chart just lays it all out, and it is stark. Look at this. Plaintiff A has a discrimination case. They report $100K in income, but they get a $40K deduction, so they're taxed on the $60,000 they actually walked away with. Makes sense. Now look at Plaintiff B, a defamation claim, same $100,000 gross income. Deduction, 0. So they're taxed on the full $100 grand, even though they got the exact same $60,000 check as Plaintiff A. And the results, they can be absolutely devastating. I'm not exaggerating. Because of how our tax brackets work, it is entirely possible for a plaintiff's tax bill to be more than the money they actually got to keep. Think about that for a second. You go through a lawsuit, you win, and you end up poorer than when you started, all thanks to this tax trap. It's incredible. So here's the bottom line. We used to have a system where your tax bill was a matter of geography. Now it's all about your cause of action. The tax code itself is now making a judgment call, saying some legal injuries are worthy of a tax break, and others, well, others are not. And that decision has huge, life-altering financial consequences. And that leaves us with a really critical question, especially for any legal and financial professionals watching. This tax trap isn't just some paperwork issue you figure out in April. It's a massive strategic problem that has to be part of the conversation from the very beginning of a case. I mean, how do you even approach a settlement when you know that a supposed win could actually bankrupt your client? It completely changes the game.